Free and clear of the chatter from Wall Street, you're listening to Talking Stocks Over Beer, hosted by hedge fund veteran and newsletter writer Mike Alkin, who helps ordinary investors level the playing field against the pros by bringing you market insights and interviews with corporate executives and institutional investors. Mike sifts through all the noise of mainstream financial media and Wall Street to help you focus on what really matters in the markets. And now, here is your host, Mike Alkin.
Welcome to the podcast. It is Monday, October 22nd. Hope you had a good weekend. I am sitting here right now with a couple of colleagues of mine on the open road in Colorado. We are looking at snow-capped mountains as we head into Wyoming and South Dakota, going to look at some uranium projects. So if you hear a little background noise, that's the 80 miles an hour on the road in the car. So I apologize. But we're going out looking at a bunch of different projects in the uranium world and looking for value. So, as I think about going to doing this, right, you go out and you drive into, we flew into Denver and I'm going to drive about 4.5, 5 hours. I wasn't into getting a 14-hour double connection flight out of New York. So rather just go and drive and fly to Denver and then drive, but drive the 4, 5, 6 hours that we got to get to where we got to get to. But I am, it's funny when we're thinking about looking for value, deep value. Obviously, uranium is one of those things right now that I categorize as a real deep value left for dead industry. And you've heard me talk about uranium before. But when I do, it would be categorized as what I would say an asymmetrical investment. When I talk about asymmetry to me is there's, I believe, if the thesis is correct, there's in anything when we're talking about asymmetry, is the risk reward is very skewed. And if I'm looking at the long, the risk means I have dramatically much more upside than I do downside. And that's what I mean by asymmetry. And conversely, if I'm looking at short ideas, I think the downside is tremendous and there's very little upside. And so, and it's hard to find those sometimes sitting behind a desk. You got to go out and hunt them down. And so that's kind of what we're doing here. And to talk about that, I'm going to keep the intro short only because, I'm driving and just got a lot going on right now with some calls and stuff. But so we're going to bring on a guest who I have just a tremendous amount of respect for. I've gotten to know him over the last year, and we talk quite a bit, and we talk about investing ideas, and we'll spend a couple hours on the phone, and doing that. There are times where I think, geez, he's inside my brain. Not that that's a good thing, but it's interesting because he's an asymmetry hunter, and he ignores most of the market like I do. He's not looking at. I couldn't tell you probably on most days what the S&P did or what the Dow did because, we're out just looking at one-off ideas or one-off industries. I'll catch it up at the end of the day and see how it did. But just looking for stuff, he makes his living looking through undervalued long and long ideas and looking for stuff that has been discarded, it's thrown on the trash heap. And when you do that, most of them, the market is reasonably priced. It prices in most of them correctly. So you have to keep sifting through, and it can be tedious. You can be looking at industries or a company, a one-off type company, and you're just looking for different attributes, which we're going to talk about in the interview. But you're looking at things, and most of the time you just say, you know what, they deserve to be here. But once in a while, you find a company or a sector where you say, wait a second, I think there's change taking place, and even if it's going to take a little, or even sometimes a lot longer. What's the price I'm paying, and what's the value I'm getting? And if that trade-off is such where the risk reward is so dramatically skewed to the upside, well, then you might have yourself something. So I'm going to bring on Chris McIntosh. I've had him on before, but what we're going to do this time, I really want to drill down and talk to Chris about his investing framework, his investing philosophy, how he thinks about the world of investing. And hopefully you'll get a lot out of it. So without further ado,
Chris McIntosh, welcome to the podcast.
Thanks, Mike. It's great to be on.
It's always good to talk to somebody 17 hours away.
Well,
we both sound fresh, right? Not one woke each other up in the middle of the night, so it actually worked okay.
Yeah. Well, it's the advantage of being in Mordor.
Yeah.
I got the first of everything. If you want to know what the stock price is going to close at, just give me a call. I was on my head again. If only it was that easy.
A head start. So, Chris, you know, you have capitalist exploits, and I have been reading that for a while now, and I got to tell you, I love the way you think and the way you frame an investment idea and the way you think from a macro perspective and the second order of thinking that comes along with that, and always kind of looking around the bend as to what's out there, but not looking around the bend to say, oh, what's working? Let me go chase it. It's just the opposite. It's a deep value approach to investing with a very long time horizon. So why don't you, for listeners, talk about your investment philosophy? How do you think about the world of investing?
Okay. It's probably not the easiest thing to actually talk about.
I'm going to let you run.
I guess it's one of those things you know, when you're asked a question like that, what is it that goes into how you think about things? There's a whole lot of stuff in there which has got you to the point that you've got to, and then it's hard to quantify. But
let's start by this way. Let me interrupt you for a second. Let's do this. A name that's near and dear to both of our hearts. So I look at a big open-ended growth story like Tesla. Let's use that for example. And I look at that now, aside from the fact that the SEC charged Elon Musk with fraud, and he just settled the agreement. But I look at that, and aside from the carnival barker that he is, and the promises that he never delivers on, but there are millions of people who look at that and say, "Look at this open-ended growth. This is unbelievable. Look what can be down the road 2, 3, 4, 5 years when AI kicks in and the autopilot is fully self-driving and they have their own chips and it's going to right and then my God, he's going to let's shift gears from Tesla. Let's go to boring. He's going to drill a hole through the city and then he's going to take people to Mars." I look at most of that stuff and not immediately call bullshit, but I'm more inclined to call bullshit on that type of stuff, the big pie in the sky stuff. But hey, you know what? In the stock market, it takes bulls and bears, and you see the stock go up. When I look at something personally that's on the trash heap, it's the sector, the stock is down 70, 80, 90%. Nobody likes it. Everyone's walking away from it. I kind of get excited, and I say, oh yeah, maybe there's some value here. Where are you on that spectrum?
Well, what you've just described, Mike, is really, in its essence, asymmetry. If we go back to Tesla, let's just play that game, and let's assume that, because we're both bears.
Yep.
And bear in mind, I wasn't initially a bear because I thought that Elon Musk was a fraud. I was purely a bear because math exists, right?
Yeah.
And so
the other was just icing on the cake.
Exactly. But nevertheless, we're at where we're at today, and the stock is still trading at an insane valuation, which is really just testament to the fact that people, by and large, are sheep. And there's another element which Tesla has, which very few other companies have. It has a cult status. What you're dealing with essentially is a religion as opposed to an equity. And religions, or ideologies, if you will, are very powerful things. They can outlast our human life quite easily, and have done in the past, and will continue to do so in the future. So in that respect, shorting something like that is not necessarily the smartest thing to do, because you can get run over. So that's one thing. But when you think about your potential for that growth that the bulls anticipate. The $4,000 a share that ARK Invest discuss. You've got to, everything is just a set of probabilities. So when you run that on a probability scale, it's far off the deep end. I mean, it's not even quantifiable. So even if she was correct in that assumption, that's still not the game to play, because the probabilities are not in your favor. It's akin to going to Vegas and saying, well, you could win $1 million with $1,000. That is true, but it's not a probable event. So it's not the way to bet. Then if you take an instance with a sector that already exists, that has dynamics and fundamentals which are calculable, because what you're dealing with AI and with all this other nonsense is a set of probabilities that you don't know, because you're talking about technology that does not yet exist, and that may or may not eventuate into something.
And Chris, by the way, I'm going to interrupt you for a second. You, in your prior life, were a venture capitalist who saw pitches all day long on technology. So it's not like you don't know from what you're speaking about big future bets.
Absolutely. And quite frankly, it's one of the reasons that I stepped out of that in 2015, because, here we are 3 years later, and that entire world has become a complete Ponzi scheme. It just, everything has been built on these growth multiples, which coincidentally is actually a consequence or a knock-on effect of by and large quantitative easing. When you're pushed into a setup where yield is basically unachievable without taking extraordinary risk, then people take extraordinary risk, which is exactly what we've seen, which is why EM bonds have got bid, which is why things like Tesla exist, because the stuff that has worked, if I'm going to use that word, when I say worked, I mean gone up in price, has been growth technology. And a decent chunk of it has gone up in price while not producing any profit whatsoever. And so there's a dynamic that exists there within the venture capital world that is a consequence of central bank activity. Nevertheless, if we go back to what you had initially alluded to as a sector that is understandable, is cyclical, and you're not dealing with AI, you're not dealing with some unknown set of facts, that on a probability calculation is much, much more easy to deal with. So you and I have discussed in depth uranium, amongst other things, so we'll use that one, and I guess many of your listeners are familiar with it. So there you've got a set of known factors, right? And we know, for example, that uranium is not going to go away as an energy source, and we know that because there are a number of power plants in existence today that are not being shuttered. We also know that there are a whole set of new power plants being opened. We know what the existing supply looks like. We know what, all of these factors are known factors.
Calculatable.
And that gives us, sorry, go ahead.
Calculatable.
Absolutely. So then you can run a set of probabilities. And typically the only thing that you're dealing with is time frame. It's dealing with, what you're dealing with is a when, not if situation. And those I like the best, because on a probability, again, look, if you go back to Tesla, let's just say we got it wrong. Okay, fine. It's trading at like nearly $300, $250 a share. So, if we were going to get, I don't know, a 10 bagger out of it, we need it at 2.5. Like, it's just so difficult to get there. On the other hand, if we take a number of uranium companies, and even if we just took a basket of these things, for us to get, 10x is a hard ask. But again, the probability compared to Tesla is just, it's in order of magnitude higher. So those types of situations are, from an investment perspective, far, far more stable, far more lucrative. And, as you know, Mike, in this world, you can talk about the stuff that is on the headlines, and that'll sell newspapers. And in our world of publications, that's probably what you and I should do if we wanted to sell stuff. But we're money managers, and it's a stupid way about going about managing money. So
you mean you're not coming out with a cannabis edition?
Cannabis is the .com of today.
Yeah,
I tell you. So and look, I mean, I'll be the first to admit that I missed that boat.
Same.
And there were friends of mine who made out like gangsters on it, and who notified me of it, and I missed it. I was looking at other things and so on and so forth. Nevertheless, there's where you've got this set of probabilities that are quantifiable and knowable. That's really what you want to be looking for, and then you're just looking for the time frame. So, and that's the most difficult part. But it tends to be stuff that's hated, and so when you point it out, it's not an easy sell, and that's fantastic.
Yep.
I mean, if we take, again, can move back to uranium, we could talk about a whole lot of stuff, shipping, oil and gas, you name it. You've got these sectors. I mean, I think it was the conversation that you and I had more recently when we were discussing capex involved in something like, say, offshore oil. It's enormous. I mean, you want to put a rig out, it's over $1 billion. And you have this, so that's a debt-based sector. It has to be. Like, nobody comes in with cash, $1 billion.
Yep.
So it's always, almost always financed with debt. And you've got this situation where you've got a bunch of companies that have just been decimated, and much of the sector's been wiped out, kind of like the uranium sector. And then you're sitting with a setup where you have companies with existing assets, oil rigs, and no debt.
Yep.
And you ask yourself, how the hell do you get to such a situation? And the answer is that equity holders have been completely wiped out. Debt holders have been converted into equity holders and pretty much wiped out. And so you have this unique set of circumstances where you have assets that are worth billions of dollars with no debt.
Yep.
And nobody's interested in them.
Yep.
So those are the kind of things that you look for. In terms of, look, I used to be an investment banker before getting into venture capital as well, and there's dozens of analysts.
Why don't you complete the trifecta? Were you a lawyer? Because if you were, then you'll have 3 legs of the stool, and we'll just hang up now. So
yeah. So I guess the point is, like, I grew up looking at analyzing stuff, and there's no competitive advantage there, because numbers are numbers, and everybody can analyze them, and by and large you come away with the same conclusion about things. And what I realized over the years, mostly from getting smacked around the back of the head, was that I guess it's what has been, there's that old saying, markets can stay irrational longer than you can stay solvent. And to a certain extent, that's really what you've got. And there's other dynamics at play there. And so I look a lot at behavioral finance, social factors, and geopolitics at a macro level to try and understand what's going on, because I still believe Druckenmiller is right. The thing that moves markets is liquidity.
Yep.
And so, you could be right on a fundamental basis for any particular equity, but if you're swimming upstream, it's a very, very tough thing to do. And you can essentially, you're right when you're making money. That's kind of what it comes down to. And so you could be invested into some equity which is just not performing well, and you cannot understand why the hell it is, because every analytical skill that you have tells you that shouldn't be taking place, and yet it is. And that's as a consequence of a macro factor. It's a little bit like sitting in a forest and going, this tree has got all the sunlight in the world, it's getting rain, it's like, why is it like, why didn't people not realize it? And then you scale out and you realize the forest's on fire. And it's like, well, your little tree's going to probably die anyways. So you need to focus on some of those things. And that's, I guess, what I've tended to do over the last decade or so,
Right.
is looking at these kind of macro elements that play in or cause capital to shift.
So I get asked a lot of times is, how do you come up with your ideas? And we have the exact same, identical investment framework and philosophy. So people ask me, how do you get your ideas? What are you looking at? Right. And I tell them, I don't know. I'm a voracious reader and I stumble across things, and I do it because I just cast a wide net and I look for things that just intuitively don't make sense to me, where there's a disconnect. And that's how I found uranium 3 years ago. And then once I do that, then it's diving deep to understand the fundamentals. Because I love the guys who screen for everything, right? Because like you said earlier, it's with banking, it's all numbers, and everyone has a spreadsheet. Everyone could look at the numbers. Everyone could put the projections in when things are working, and when you're trying to paint a big dream. But not everyone can take a different view. So for me, it's just stumbling upon stuff from casting a wide net, being a voracious reader, and looking for things that are out of favor or things that are just don't pass my smell test right away. What triggers an idea for you?
That's a good question. I guess it's important to not be contrarian for contrarian's sake. I do believe that
absolutely,
because you can go down that analytical path, and you can find sectors and assets and so on and so forth that again look very favorable. I kind of do that, and then I scale back out and say, okay, well, what are the macro factors in play? How is capital shifting around the world? What's liquidity like? And when I mean liquidity, I mean large pools of capital moving, both on a sector basis as well as a country basis, and then trying to fit it into that and seeing if it fits. And if it doesn't fit, sitting and just watching it. I mean, I've got like a dozen things I've just been sitting watching for years, which I know 10 years ago, I would have bought them. I would have thought, okay, I got to buy this, and it would have been the wrong decision.
Well, that comes down to the word, Chris, catalyst, right? Because it's identifying. You can find so many things, and to what you said about contrarian for contrarian's sake is a recipe for disaster. When I find stuff, I still might see it and see great value there, but a lot of stuff I pass on because I think it doesn't matter. If I see it, who cares? Everyone else has to see it. And what is it? What's that event or series of event that's going to cause money flowing in or out of, if it's a short, into that sector? And then it's identifying those catalysts, right?
Yep. You've got to have that catalyst. So, for example, here's a good one, where I got smacked around the head. This would have been back 2010, I think it was. Don't quote me. It was around about 2010, 2012, somewhere there. I was looking at the bonds, at sovereign bonds, and this kind of structure in play where they were just getting bid, yields were collapsing, and I thought, and then you looked at the debt in most of these. I'm talking predominantly developed world countries, and I was like, this doesn't make any bloody sense. It's like, you have to short this. But I've learned that, you don't. For me, I need to put my feet in the water, because then I pay attention to the temperature. If I'm just looking at the water, it's not the same thing. I kind of need to just put my toe in and feel the temperature, and that's not going to hurt me. So basically what I do is I'll take like a half a point position, right? Which is meaningless in terms of.
But it's on the sheets and it makes you pay attention.
Basically I'm screwing with my own psychology, right? I'm making sure that I pay attention by putting some capital down, and then I really sit and watch it. And so I did that with bonds, and I got run over, obviously. Okay. And then I was like, well, okay, why is this not working? Why is the market not adjusting as it previously would have? And in that instance, I believe that the reason for that was that you had a set of circumstances where you had global central bank cohesion or coordination, if you will, that we've not seen at any level in history. And so you had the major central banks of the world, the BOE, the BOJ, the ECB, and the Fed, all coordinating the same policy. And there's a number of reasons why that took place. We don't need to go into it. But the point is that as long as that setup remained in place, you weren't going to get a break in that market. You weren't going to get a break in the market because there's nowhere to go. If you and I can move out of that and go, oh, well, we'll go and buy some Norwegian kroner or whatever the hell we want. But if you're a large sovereign wealth fund, or if you're a big pension fund, you can't do that. You can't go and move $4 billion net settled day end into kroner. Yeah. It's just, you're going to hurt your own position. So you're not going to move it. So you're going to look around and go, oh, well, today, I guess the euro looks a little bit better than these other shitty ones. And you buy that and you kind of shift around between the big boys. But they're all playing the same game. So I kind of realized that you had that overall structure in place. And then I was like, well, firstly, what's holding it in place? Well, what was holding it in place was a threat to the developed world politics. It's not, and that politics was threatened as a consequence of the economics being threatened. So that's why those policies were enacted. But that in itself laid the seed or the seeds for what we're seeing today, which is a rising nationalism and populism, because you had this massive distribution of wealth that started taking place. Anyways, so quite frankly, that's why in, I think it was 2016, I wrote an article called Rise of the Strongmen and What It Means for the Global Economy. And that was, I guess, a formulation of a whole lot of thoughts around how this was playing out. And it's how I managed to gratefully, accurately anticipate Brexit and Trump, and the rise of, they're calling it alt-right, which is kind of more center really in Europe. In any event, those that you could see why that would take place, you could see how it would take place on a social basis, and that in itself, when you think through the second order event of that, it's impossible for central bank policy to stay coordinated in that world. And guess what? It doesn't.
Chris, I just on last week's podcast, I spent time talking about an article I read that Ray Dalio had written from Bridgewater, and he said, that right now geopolitics are playing a greater role in driving world economies and markets than any time in his 50 years of investing. And when a guy's worth probably $20 billion and manages a few $100 billion, he's worth listening to. And he talked about, the most important things in his view happen over and over again, right? That there's this cause-effect relationship and they're timeless. I see that when I look at cyclical industries, right? I love that. But then he goes on and he talks about the conflicts within countries and between countries, and all because of this wealth income opportunity gap and these diverging values. And he talks about the rising powers like China emerging to challenge the existing powers like the US. And he says, this big rise in populism is leading to really important policy shifts that influence economies, and the tariffs, the sanctions, the capital controls, the big corporate tax cuts. And he thinks the market implications are enormous. and he attributes so much of it to the rise of populism. And they did a big piece of work on it. It was very fascinating.
I couldn't agree more. I mean, but then you think of what are the second order events of that, and so here's an example. Let's go back and think about the QE. So QE basically pushed. It meant that everybody went yield hunting, right? When you can't get yield, you go yield hunting. So we had EM basically got bid, growth stuff got bid, crap like Tesla got thrown in there with it. Now that that's changing, this feeds into an alternative, because those growth stocks are now competing with an alternative, because you got a higher discount rate that investors have to consider when you think about discounted cash flow models. And that's kind of important for a lot of those tech stocks, which is really, I guess, just another way of saying that risk is getting recalibrated.
Yep.
So
risk on and risk off.
Well, it is to a certain extent, but it's also how, because it's like, how do you define risk?
Yep.
Right. Sovereign debt, for example, has always been considered to be low risk. Well, it depends on what the sovereign debt looks like. By and large, for the last 20 or 10, 15 years, basically growth stocks have been like fairly low risk. Even when you look at the volatility of them, the volatility has actually fallen. And then, of course, you've got all of the ETFs and all that nonsense that come out with low vol ETFs and all that kind of stuff, which further exacerbate that same dynamic. But if we think about in that whole space, one of the sectors that really didn't win, because there were the winners and there were the losers. One that didn't win, and there's a host of factors. Some of them were social, market zeitgeist, and then some of them were purely economic as a consequence of financing costs, and that's energy. So, and again, with energy, metrics are known mostly. In any event, this is how at least partly we come to a situation where capex in energy collapsed. For example, there's like in 2017, the global oil industry discovered about 4 billion barrels, and global consumption exceeded 35 billion. So that's like a 30 billion gap.
Yep.
And since 2012, global oil consumption exceeded new conventional oil discoveries by about 210, I think it was 210 barrels. That's a lot. Now, if you think about it another way, it's been about 18, nearly 19 years now since conventional oil discovered has exceeded global consumption. And this is the stuff that no one's talking about. So there was risk. That was considered to be risk. Why would you risk putting capital into going and finding oil? I mean, that's risky, right?
Yeah.
So it didn't happen. And look, part of it was this whole, we're going to get energy from the stars and unicorn farts and God knows where else. And some of that is somewhat true. Alternative energy is much, much more efficient today than it was in the past, and so on and so forth. But, traditional energy has, as a percentage, it's declined in consumption, but as an aggregate number, it's increased. And there's been no capex into it. So that's basically a knock-on effect from quantitative easing and a number of the other things that are going on. But then you come back to the geopolitics we're talking about. So in this geopolitical world that existed before, I would say before 2016-ish, it was all kumbaya, one for all, happy. And there wasn't there wasn't risk to the extent that there is today. Europe was pretty happy with the US was pretty happy with Europe. Russia was probably the least, in one of the best positions, one could say, in the last decade, or at least I should say the relationship was one of the best it's been. Wasn't great, but it's never been great. Relationships, just across the world were relatively benign. And as a consequence, in that kind of environment, people, policymakers, governments in particular, military, don't see a need to address some things like security. And I mean, I guess the most egregious example is if you think about the formation of the EU. So the EU, if you were a member state of the EU, you didn't need to basically spend too much time considering military, because you didn't have a border anymore. Not really, right? Your border was now an external border. That was an EU border, as opposed to, let's just say, for example, you were Italy. So those domestic borders went away, and you didn't need just the military personnel, for example. What you had was, on a large scale, you had a lot of these countries decreased military spending, and they basically said, okay, well, the EU will take care of it. And then at the EU level, they basically said, oh, NATO will take care of it. And basically NATO was the US, right? So all of this stuff basically just got pushed down the curve towards a point where the US was basically looking after Europe, right? And then, well, where's Europe getting their energy from? Increasingly, Russia. So now that's obviously a massive conflict.
Yep.
And you're going to see the scaling back. That's what we've been betting on, and we're already seeing it. I mean, Salvini is already, making noise, and we're going to see. We're in the early innings of the breakup of the EU, and that's fine. You can look at that and go, well, that's all good. And you could bet against the euro, I guess, and a number of other things. But when you think about the second order events, a lot of these countries are going to retreat and retrench and look to securing their own politics. And you cannot have a country and a political system that's in any way or shape or form stable without security of energy.
Yep.
And that is super, super important. And so then you come back and you realize that you've got this sector which has been absolutely slaughtered. Nobody's paid any attention to it. Because people have said to me, how can you be bullish on that sector? Because world growth is lackluster. And it's like, this has got nothing to do with world growth. It's got nothing to do with world growth, really. This is a geopolitical factor. If you get some world growth, that's just
substitute. June of last year, I gave a talk on uranium. And I was up in Vancouver at a conference, and I talked about it. And part of what and I think a few months before on Real Vision TV, I talked about it. And I put in there a slide or two about the geopolitical risk of Russia, how they have been quietly amassing through themselves and Kazakhstan and a tiny bit of Uzbekistan, but they control half the world's uranium enrichment market. And the Russians do, but the Kazakhs, Uzbeks, and Russians control half the world's uranium market, the actual U-308, and the great geopolitical risk that, and energy security risk that the U.S. faced. And it's interesting because if you go back to the mid-'80s, the U.S. was almost producing as much uranium as they consumed in their nuclear power reactors. And you fast forward to today, and 98% of what they need, they import. And a good portion of that is from those countries. And we see what the Russians do with the Europeans with natural gas, how they hold it over your head. And you look at what Russia does, they use energy. They can't fight the U.S., right? They can, but it's not about more guns. It's about using energy as a weapon. And
absolutely.
Right. So if you think about Russia and China, what they do is They go to a country that wants to an emerging market, developing economy, and they're going to build a nuclear reactor. And they say, "Listen, we'll finance it for you. So we'll lend you the several $billion. We'll provide the uranium. We'll provide the conversion. We'll enrich it. We'll fabricate it, and we'll operate it for you." And the country says, "Wow, great! Look at that!" And now they own you, right? Because they've taken your economy up. They've provided you with clean, safe power, and now they use it as a tool. And I was saying when I spoke, that's America now. 20% of its electric grid is nuclear power, and you're relying on the Russians. And at the time, people would come up to me and say, "Come on, really?" And fast forward a few months, and Putin came out, and in the Duma they came out and they passed some legislation where it's up to Putin himself as to what he can withhold from sending into a country, and uranium is one of those. The other thing you saw was a couple of uranium mining companies came out and they filed a Section 232 on the grounds of national security to say, "Hey, what about us, Uncle Sam? We need help here because we're getting hammered by cheap uranium being flooded into the market from state producers, Kazakhstan." But it's a great tool for countries to use, and there are a lot of knock-on effects. Now, at the time when I was talking about uranium, everyone told me I was crazy, right? But if you just look around the corner, sometimes there's some real value to be found. And like you're saying here with oil and gas, I mean, my God, as you reduce your dependency on those countries, they're going to have to go find their own stuff. And there you mentioned earlier in the call, you've got these drillers that typically are debt financed. They're sitting there with no debt, right? So think about when they don't have to pay interest on that debt or a minimal amount of interest.
When the margin expansion is
the margin expansion is crazy, right? So, but so that leads into then time horizons. So two things. One is time horizon, and then one is thinking about risk reward. And you mentioned you talk about it, I talk about it, asymmetry, right? So the way I'm looking at this type of stuff, and I'd love your view, is I look at this stuff and say, okay, I think there's a thesis here. So now I've got to try and figure out what the catalyst is. So if I can identify a catalyst, what's the time horizon on that catalyst? Is it 6 months, 12 months, 18, 24, 36? And I'm willing to wait longer, the better the risk reward is. And risk reward meaning if I'm right, what's the upside, right? Is it 2x, 4x, 5x, 10x? If I'm wrong, what's my downside? Right. So if I could look at a situation where I think if I'm wrong and I have 30, 40, 50% downside, but if I'm right, I have 5x upside, right? I have 500% upside, I have 50% downside. Well, that's 10 to 1 risk reward. I'm saying, my God. And if I can identify a catalyst, how do you put that into the hopper when you're thinking about your investment decisions?
Yeah. So again, you screw with yourself psychologically because the biggest danger is probably between your own ears and believing things that you want to believe, right?
Yep.
So
absolutely,
I try not to get excited about anything. I look first at the risk on the downside. I say, how can I lose money on this? And if I do lose money, how much? And what does that look like? So if we've just been talking about the offshore oil and drillers, if you look at that sector, you've got it's like about 80% of the companies have gone away. They just don't exist anymore.
Yep.
And the market caps are down almost, some of them 90%, very similar to the uranium space. So then you look at it and you go, okay, well, one or two things is happening. Either we're sourcing energy from alternative sources, and we're not going to need oil from offshore maybe ever again.
Yep.
Is that realistic? And then you look through the numbers and you go, well, no, that's not at all realistic.
Yep.
So that's kind of that taken care of, because that's your risk, right? That you see something, you think, wow, that's, look, none of us want to be in that Kodak moment. We're like, oh my God, look at you got to buy this thing. It's like, well, hang on a second, print it, that photography's gone away. It's all digital now. So that can happen, but it happens far less than most people think. We all remember Kodak. We all remember the internet. We all these are life-changing technologies that we will remember them. But for every one Kodak, or should I call it digital photography phenomenon, there's like 100 that people thought were a phenomenon and are not.
Yep.
And so when you think about in the energy space, you could look at solar, and you could look at wind, and you could look at should even trying to get run over river hydro, things like this. Anyways, and certainly solar is taking up a much bigger chunk of the space now, and it's much more economical and so on and so forth. But there's all sorts of other components that go into that, which is storage, battery storage, and so on and so forth.
Yep.
And it's really not competitive with baseload energy. It's not. It might get there at some point, but it's not now, and it's not likely to be at least in the next 5-10 years.
Yep.
So that's basically looking at that downside and saying, okay, well, if I'm wrong, like, where am I wrong? And then the second question is, okay, well, provided that this analysis is correct, and we are we're still going to need offshore oil, because again, 30% of our current oil comes from offshore. So if that doesn't change, then what's the risk to me in the sector? Well, then it's just a timing risk. It's like the leftovers that are in there, and there's not many of them left, either go bankrupt or they stay alive. So now it just becomes a situation where you don't want to bet on the wrong horse, A, and B, you say, well, what's that catalyst? And I think we just dealt with what I believe is the catalyst, which is this geopolitical shift from a world where we believed that everything was hunky-dory, safe and sound, to one where, who are your allies? Japan is sitting there going, hang on a second, can we really rely on the US? South Korea is certainly doing so. Europe is certainly doing so. So this creates uncertainty, and that uncertainty we're already seeing at policy levels where they're shifting, and they're trying to figure out who their new allies are. And in that environment, it's not a growth story. It's like you're hunkering down, Mike, and it's like you and I are sitting there going, okay, who are our friends? And you know what? Let's lock our doors, and let's make sure that we've got secured supplies in the cupboard. And let's go out and secure more, because we realize that our pantry is empty, and we need to go and stock up. And so that's kind of the environment that we're very, very quickly moving into. So I think that's the catalyst for the energy space. As if we sort of come back to the offshore oilers and things of that nature.
Well, it's interesting when you started talking about it, you said, no, it's not when you look at the numbers. And that was key that you said that, because one of the things that attracts me to industries that have been left for dead by investors is there are less eyeballs on it. There are less institutional eyeballs. There are less sell-side analysts looking at it, typically. And then you bring biases. If you are an energy specialist and you have been looking at the offshore drillers for years, things can be changing, but you've been hammered for so long that you're not going to believe it. And you might have seen it before, you've heard it before, and people don't tend to either lose focus or they get sucked up into the existing narrative. And for uranium, I see that a lot. But then you mentioned the numbers, right? Because when fewer people are looking at it, fewer institutions who have the spreadsheets and the numbers, and they're sitting there and they're looking at it, things fall through the cracks, and you can really capture the changes that are taking place if you just come at it with a fresh set of eyes and say, all right, let me think about this. So you've got your second order thinking, and then because the first order of thinking is what gets priced into stocks, right? The second order of thinking is what causes that change, and what's around the bend. And then when you can marry it with numbers, and I see it, running a uranium fund, right? I have everyone and their mother coming after me with the bear case, and potential investors will call me and try and ask. And almost all of them are driven by sentiment, or almost all the bearish arguments, sentiment or personal viewpoints. They don't come at you, the arguments, with the numbers. And when that makes it so much different when you can make an argument, fact-based argument, a numbers-based argument versus an emotional argument. And oftentimes people are emotional creatures and they invest emotionally as much
Not
as
oftentimes, all the time.
all the time, right? And you and I, we you have to kind of divorce yourself from the emotions, and it's hard, right? I see it for me, it's Tesla. When I look at Tesla, I just think, are you kidding me? When I read some of the bullish posts on Twitter and some of these people, I sit there and say, my God, they're either innumerate or they're a cult. And then you recognize they're a cult and you say, okay, I get it. But when you can just simple math, and the thing I love about this business, it doesn't require more than a fourth grade math education. If you can add, subtract, multiply, and divide, you pretty much got it, right?
Yeah.
And so for me, that's it. And so you nailed it. When you said, when you look at the numbers, the numbers tell the story.
You pointed something else out, which I think is really important. And you said that the people within the industry can often miss it. And there's a real danger to being in any industry. You become myopic to, again, you're in the trees, not looking at the forest.
Yeah.
I mean, look, how many newsletter guys out there have been calling for gold to go through to like $5,000 for the last 20 years?
Yeah.
Right. And so that's almost like a bit of an ideology in itself. And I'm picking up gold, but you could take energy, you could take whatever, right? And so, the reason that you and I think alike is like, you're not a uranium guy, Mike.
No,
you're not.
Nope.
And I'm not look, I'll be the first to admit that my knowledge of the offshore drilling space is pathetically bad, right? I mean, I've read up about it, and I guess I probably understand more than the average dolt sitting out there. But the point is that I'm not a specialist in that space. Likewise, shipping or interest rates, whatever. And that's really, if I've got an edge, that's, I guess, where my edge is, and I think it's probably where yours is too.
Yep.
And there is that real risk where if you're stuck in that particular industry, you're surrounding yourself with other people, and they've all gone through the same stuff that you've gone through. So and you can see it at a CEO level. No CEO of a major oil company is prepared now to go out and tell their shareholders that they're going to do a big CapEx spend. None.
He'd lose his job tomorrow.
I mean, because he's going to lose his job tomorrow.
Yep.
And because anybody who tried doing something like that in the last couple of years has lost their job, and then their share price has been hammered. I mean, their share price has been hammered anyways.
Yeah.
But so you have this kind of, and you speak to these guys, and they're like, no, they're hanging on for dear life, and they're exhausted, and they're really not prepared to rock the boat.
Yep.
And so I find it valuable to get insights from them, but I don't find it valuable to get to try and understand what could turn that sector, because they're not looking at it. They're really not. They're looking at flow rates, and they're looking at all these other things, which I need to know, but not as much as you would think. And so, I think that's like, for investors, it's, you don't need to be a specialist in these areas. Where you find a sector that you think provides you with a good risk reward setup, by all means, go and spend money and spend time on people that are specialists in that sector but don't expect them to tell you when to get in or to get out. Like, don't. I mean, look, you're in uranium, right? I mean, we could look at I'm going to pick on Paladin, right? Because it did so exceptionally well in the last bull run. But guess what? And maybe I shouldn't do this, but let's just say that we went to the existing CEO at the time, right? Now he had the stock and it ran from, what was it, like 10 cents or something?
Yep. One penny to over $9.
Yeah, so nearly $10. But guess what? He was sitting there when it ran all the way back down again.
Yep.
And so, like, you know, there's a prime example that you need to be in control of the bus, right? Because no one's going to tell you when to get off that bloody bus.
Yep.
And no one's going to necessarily tell you when to, well, actually, no, everybody in the industry that is, say, a CEO is going to tell you to get on, because it's always a good time to buy.
Yep.
I mean, it's like if you go to a barber, it's like you always need a haircut, right?
Yep.
So, other than me, I shave my head, so there you go. I don't need a haircut. But so I guess that's kind of an important thing for people to sort of understand. But I do, I mean, look, that's frankly why I hired Jamie for the Resource Insider, which we launched, because I fundamentally believe that we're moving and have already actually shifted into that space where we want to be owning tangible assets, in particular in energy, but across various resources. And not all resources are the same. It's not good enough just saying, oh, well, because some won't necessarily benefit. But I realized that I needed to have somebody that was super well connected, that, basically wasn't a carnival barker, that was a guy who's a mining engineer. He knows this stuff. And like, I don't know it, but I realize I need to know it in order to get me, better alpha within the space.
Yep.
But I said something important to him when we partnered, and I said to him, this is what we want to do, or this is what I want to do, but realized that I don't want to work with you if you don't understand that at some point I'm going to close this entire thing, and it's probably going to be the time when everybody wants into it.
Yep.
Because that's the time that if I can't put my own money into it, I'm not prepared to do it. End of story. Life's too short to deal with that sort of shit. So, and he's like, okay, great. So anyways, I think the point is that on a risk reward basis, I look at risk first and foremost. I almost don't even, I try not to think about the potential upside. I mean, you run the numbers and you look at the stuff and your jaw sometimes drops, but I try not, because at the end of the day, we know how markets start pricing in. Look, think about how markets started pricing rates dropping. It became this long, and I believe rates turned back in July 2016 when the Swiss sold their 50-year for negative, and some poor dolt bought it. So, but even between then and then over the last probably 18 months from then, we had yields rising, but on the long end of the curve, they were flat or inverted, which basically meant that the market didn't believe in what was taking place, right? It was kind of like, oh, this is just temporary, short end curves moving up, but long end was all still pretty low. Now, over the last few weeks, we're seeing that change dramatically, all maturities. And that's really, really, I think it's a radical shift. And I'm not seeing many people talking about it. They're talking about the equity market and, the S&P got a bit hammered and, what about Google? And it's like, forget about that. Just like think about this major shift, and then think about how asset classes move and how liquidity moves, because this is it's a massive shift, and it's at a geopolitical level. So anyway,
so let's shift gears for a second. Let me because you look at things on both the long and short side, and in your corner of the world, you've not quite, but your neighbor in Australia has had quite a housing boom. What's your view on what's going on down there in the Aussie housing market?
So look, I mean, This is a consequence of that environment that we began this discussion with. When you have a sector that's continued to go up, and it's gone up as a consequence of yields collapsing, it's kind of like reverse margin expansion, right? So you can afford to borrow more money when your cost of capital is approaching zero. It's that simple. And there's a leverage ratio in there. So this is seeing stuff just getting bid up and bid up. And then, of course, that in itself has engendered all sorts of shenanigans, which again is just human behavior. And like we can have all of they just had a royal commission out there, Mike. So, which was to investigate the banks, and the report's scathing. I mean, these guys did things that the US banks in 2008 would have made them blush. It's ridiculous. And so you think, oh, how could that happen? You know, that did it before. And it's like, it's going to happen then. It happened then. It's going to happen again. It's human. You're not going to change human nature, right? But you think about the underlying dynamics of why that existed. That is because of that entire interest rate setup. Now let's fast forward to today. So here's a few basic numbers that people can think about. The central bank, what's called the RBA over there, they have kept rates on hold. So everyone's like, oh, well, that's fine. You know, rates are on hold. And, you know, that means that property prices aren't going to fall. Well, hang on a second. Because it's a relatively small economy, certainly when you compare it to the US, they don't domestically finance everything. About 40% of the bank's book is financed in the Eurodollar market, and the Eurodollar market is basically LIBOR. So take a look at LIBOR; it's screaming higher. So what happens now is that all of those loans that they have, and they got them across maturities, right? Because they structure their book, you know how to work. So you get maybe a 3, 6, 8, 18, 12, 24, 36 month, you know, all these various maturities. Anyways, as they roll over, they're going to have to roll them at higher rates because that's the cost of capital.
Yep.
And they've been holding off moving that onto the consumer, but now they've just done it. So, and you know, again, we come back to that big geopolitical move. Rates, I don't believe, are going anything but higher, which means that 40% of their book is just going to keep screaming higher, and they're going to have to pass it on. At the RBA level, they could sit there and say, well, we're going to, they might even cut rates. But, you know, they're between a rock and a hard place, because let's just say they cut rates. Well, then the Aussie dollar gets smacked. And the Aussie dollar gets smacked, that starts breeding inflation because they're importing a whole lot of stuff. You know how it all works. So now it doesn't matter if you take the money away from the consumer by charging him a higher interest rate, or if you take it away from him by providing him with a dynamic that causes inflation, so that another 4, 5% or 2% or whatever it is of his paycheck goes on his power bill and his food and groceries and his, you know, gas bill and all that kind of stuff. The net result is the same. And you've got a consumer that's so levered.
Yeah.
It's an accident waiting to happen, and I a little bit early to tell, but I think it's already begun moving. We've had the biggest move down in the last quarter. It's been moving down 3 quarters in a row, and people are now starting to get worried. So, and there's another interesting thing, actually. I wrote about this a couple of weeks back. So, Westpac came out, they're the largest of the banks over there. They came out with something really, really unusual about, I was going to say 2 weeks back. It was about maybe 3-4 weeks back now. They turned around to a portion of their loan book, which were investors, and they said to them, you have a month to find new lenders. We're closing out these loans. That is really extraordinary, Mike. Yep. Normally what happens, because, you know, normally what happens is you sit down and you go, You look at your loan book and go, oh shit, we shouldn't have that stuff. That's a real problem. And we do one or two things. You securitize the stuff, you package it up, and you sell it. You get it off your books, right? Either that, or certainly you go to your loan officers and you go, guys, this stuff here, we're not doing any more of that. Cut it out. No more of those types of loans. We're only doing these types over here. So you do an internal quick change and you make sure that you don't take any more liabilities in that space, so that you kind of stop, I guess, doing that. But then you also, if you're trying to move the stuff, you securitize, you package it up and you sell it. What you don't do is what they just did, because by doing what they just did, they made a massive flag call to the rest of the market and to all the other banks that said, guys, we're in shit and we're dumping this stuff. And it reminded me of that. There's a clip in the movie Margin Call, where the guys are all which is the is basically the tale of Lehman Brothers, and the guys are all sitting around the table, and they've figured out that I think it's like a 25% move in the underlying assets that they're holding wipe out the entire capital of the bank. And so they're like, oh, okay, that's a problem. What do we do? And I think it's Jeremy Irons. He's playing the head of the bank, and he one of the guys, I can't remember who the actor is, he says, dump it all, sell it all tomorrow. And then Kevin Spacey, who plays the part of the I think he's the head of the traders, and he goes, you can't do that. You realize we can't do that to all these people we've been doing business with, all the other banks. They'll never do business with us again. And Jeremy Irons turns around and he says, you know what? There's 3 ways to make money in this business. 1, be first. 2, be smarter. 3, cheat. And he's like, we're going to do the first. We're going to be first. and I looked at what Westpac were doing, and I was like, they're kind of just being first. They're like, yep. To turn around and go, we're dumping all this, get another lender. What are they going to do? They're going to go to all the other banks, and there's only a few of them there.
Yep.
And they're all those other banks are looking at this, going, "Oh, hang on a second, why are Westpac dumping them? Like, do we really want to pick that up? It's toxic." This is after the Royal. They've all been sitting at the Royal Commission. They all know now what are on each other's books. I mean, look, they all knew what it is. These guys all drink together. So it's just. I think it's going to get nasty. Well, I know it's going to get nasty, but again, you come back to the timing thing. So I think the timing thing is this whole move in rates, and we're seeing that now. So that's Aussie. And then if you think about New Zealand, well, New Zealand, we don't have any domestic capital markets. So pretty much 100% of our stuff is financed offshore. I mean, I read an article from a chief economist here the other day about the housing market and, how it's turning in Australia. And he turned around and said, no, we're perfectly fine because A, we've got a housing shortage, and B, our Reserve Bank has said that they're going to hold rates low. And I'm like, does this guy not understand that we have no domestic capital markets, that our banks, which are actually Aussie banks, all finance in the offshore market, and LIBOR's screaming higher? Like, what the hell?
What is planet, right?
Oh, and he's the chief economist of the what is this? It's either the or second largest bank in the country. Far out. Anyway,
and so there present opportunities, right? What else is striking your fancy?
Shipping.
Yeah, I agree. I'd like to hear your thoughts.
Shipping. I mean, it's a complex market because they're all different. You've got your product tankers and there's various ones there, but by and large, that sector has, again, you come back to the whole QE environment. Why would you finance something that is really expensive, has generally very low margins?
Yep.
And why would you do that in that environment when you could go and buy Google or Snap or some other crap, or just go and invest it into, as has been done previously, a lot of it went into high yield EM debt. I mean, Argentina, remember that?
Yep.
I I mean, here's a country, it normally doesn't have a bloody government for more than 2 years. And they were overbid on their bond issue. It's just, anyway, so in that environment, you had stuff like that didn't get financed, and it just got wiped out. And again, like you can have a tanker that's $100 million ship, Mike. 100 million. I saw one. I was reading through reports the other day. $130 million ship. So you've got these companies now that are sitting with these assets, and they don't have debt. And you go, how can they not have debt? And the answer is that they all got restructured. So I guess that's another one. So like if you think about what to look for, it's M&A. M&A only happens at the top of a market and at the bottom of the market, by and large.
Also in the shipping, you have some interesting stuff where you have some of these that were structured as mastered limited partnerships.
Oh yeah, the MLPs.
Right, and some you're seeing more and more of them unwind, and they've slashed their dividends dramatically. So the general partner that might have had incentive distribution rights has gotten slammed, because the payouts they were getting, the distributions were cut when the dividend was cut. But as they unwind the MLPs and go into C corps, that could present some very interesting opportunities. I've spent a fair amount of time recently in that space, and I just look at some of the upside potential in some of these stocks that have just been left for dead, and you say, my goodness, really, really interesting stuff going on.
Yeah. And it's interesting because those MLPs were also a consequence of that yield hunt, because what you could do, here's what guys did. It was smart. I say smart like a fox, okay?
Yeah.
So you'd package up a bunch of these shitty old tankers that were literally like a year away from scrap.
Yep.
But your investors didn't know because it had a high yield. Why did it have a high yield? Well, they're picking up the tankers because they're almost dead.
Yep. Yeah.
Chuck them into an MLP,
yep.
and you suddenly have what ostensibly is a yield-bearing instrument with underlying collateral. And guys are like, wow, awesome. I'm getting like an 8% coupon and I've got underlying collateral. What could go wrong? And it's like, they didn't know what crap was getting chucked into those damn things. So, and then they'd lever them up, of course. So I mean, I remember I was talking to Kapi Harris, buddy of mine, I think you met before. This was like probably 4 years ago, and we were laughing at it because we'd talked to one shipping magnate who was basically just selling all of his stuff to these MLP, and he's like, these guys are complete fools, and he said they don't care.
Yep. Right.
They didn't care because they were just like, they're basically brokers, investment bankers. They're packaging this shit up and then they're selling it to investors. So long as the sausage sells, they don't really care that the underlying structure of this thing is going to blow up at some point.
Yeah.
And I remember watching this, and we were like, oh my gosh, this is just awful. And made a little bit shorting some of the MLPs, but not really. I don't like shorting. In general, I don't like shorting. It's a tough gig. And yeah, so, but now kind of at the other end of that, right?
Yep.
Yeah.
It's funny you talk about what you look at. It was, I think sometime in 2014, I took a few of the guys in my office and we went to the Bakken and the shale play in Williston, North Dakota. And we just wanted to get caught up on just seeing it, right? Because you could read and you could talk, but not until you're there do you really get the boom or bust cycles that are going on. Do you feel it? And I remember we drove a couple hours from the airport and we got there and we pulled into a hotel, and it was a Hampton Inn hotel, which is a moderate travel hotel, nothing fancy at all, but clean, nice. And, we're around here where I live, you'd pay, I don't know, $125, $150 for a room. And so here we are in the middle of nowhere in Williston, North Dakota. Mm-hmm. Yeah. And I check in, and my assistant had made the reservations, and I never really paid attention to what I was paying for a hotel room when I traveled, and I was always traveling. But when we were driving into the town, I felt like I was on a soundstage, because everything looked like it was just put up, and I felt like we were on a movie set. Like, look at this. They did. I wonder if there's anything actually behind these structures, like the old spaghetti Western sets where it was just a saloon. And so we pull in and,
hang on, Mike. Do you mean it looked like a solar city?
Yeah, right. Exactly. It looked like a solar city. Elon showing the what these roofs are going to do, and it really was a soundstage, and it didn't work. Go figure. So it had that feel, and then we go into the hotel, and I check in, and the woman says, I forget. I knew exactly what it, but like $450 for you're here for 4 nights, 3 nights, and it's $450 a night. I said, what? Like, you mean the whole stay? She said, no. And I thought, I'm paying 3 times. I live 17 or 19 miles outside of New York City, and I'm thinking I'm paying 3 times more here in Williston. So then we mosey on over to the local steak joint for dinner, and it's packed. It's overflowing with roughnecks coming in off the rigs, and it takes us 45 minutes to get in. And we're all sitting at the table having a beer, and we look around, and like guys are drinking wine everywhere. So the waitress comes over and she talks to us, and she said, I said, where are you from? She said, the Iron Range of Minnesota. I said, oh, great. How long have you been here? A few months. I said, oh, she made more money than I ever imagined in my life. I said, what are those guys drinking? She's like, Camus. I said, really? Yeah. She said, I said, wow, she said, oh, they're here every night. They're just here every night, and they can't spend enough money. They'll buy 2-3 bottles of wine, and really fancy wine, expensive wine, and buying $40 steaks. And I said, okay. And she said, well, it's boomtown here, and all these guys just bought, they buy dual pickup trucks with cash. I said, okay. Yeah. So it goes on and on and on. I was driving around the town. A friend of mine introduced me to a guy who owned a private company there, where he had invested a few $1 million in capital just a couple of years earlier. He was offered $100 million for the business, and I said, "Wow, you're going to hit that bid?" He said, "No, it's $1 billion company." I said, "Well, yeah, right." Right. So it just had that feel. After spending 4 days there, you just knew it was just it. You didn't know the exact. You knew it wasn't an if; it was a when, and. Yeah. And we came back, and the MLPs, obviously, with a lot of gas pipelines and stuff, everyone was gobbling them up. And then we noticed they were doing a few secondaries, and they started to not be taken up well. And as soon as we saw that, we said, okay, that's for us. That was our signal. Like the demand was starting to dry up, and then it just kind of imploded after that. So there are these little signs you could look at, right? So and it's interesting what to look for. So you go to a town like that, and you see it boom, you can either walk out of there going, oh my God, this is going to last forever, or, oh my God, this is going to end tomorrow or pretty soon. And, so you have to put a mosaic of information together. So I remember those MLPs well. It was an interesting time. But the shipping space is pretty interesting right now.
Yeah, you're just talking about the shale thing. I mean, that's another. So when you think about that geopolitical environment, when you had the oil embargo, that was where the US got smacked, right? And they turned around and said never again, and they started building their oil strategic oil reserves, right?
Yeah.
Well, guess what? Today they don't have any. Why? Well, because they're reliant on shale. They're like, we don't need to. We're a massive producer now. I have some concerns around that, because shale is considered and treated and evaluated as if it's Goa, and it's not.
Yeah.
The decline rates in shale are not, they're not at all comparable with a traditional find. So that, I think, is a potential, not a catalyst, but an icing on the cake for the overall sector, because again, you go offshore Mexico, like nobody's making any money with it. Nobody.
Yeah.
Right? Because we don't need offshore oil. The hell with that. We've got shale. Maybe you do, but even so, like right now, even if shale is like Goa, which doesn't make any sense to me, it's being priced accordingly. And so, like, again, you come back to risk reward, and you're like, well, if it's just a hair off, that's fairly substantial.
Yep. Also, Chris, that and from a nuclear standpoint, I look at it, and a big competitor is cheap natural gas, right? These gas plants, and everyone and their brother is pricing in $3 natural gas forever. What if it's not?
Yeah, that's an interesting space, because I think Natty looks like it's just broken out.
Yep.
On the charts, and again, like, we're looking at that pretty closely at the moment.
Yeah.
So again, you go through this entire sector, and you go like, what, it's knock-on effects. It's the second level thinking as to how these things play out, because the problem that you sometimes find, and I get this all the time with subscribers, is they'll get excited about whatever, some particular sector we're in or whatever it is, and they're like, you think, okay, well, let's go after that. But then when you look at how to actually structure the trade, it's not necessarily, Aussie housing, for example. Okay, so like, how would you play that? Well, you could short the banks, but then how do you want to short the banks? Do you want to buy puts on them? Well, firstly, there's not really that much liquidity. Secondly, when you in the option market there, you've often got like really about 9-10 months. Like, that's not enough time frame. Can you seriously be able to, like, in terms of your own mind, can you hold that position and keep rolling it for what you need to, which might be 3 years? In other words, can you keep getting kicked in the teeth psychologically for 3 years? And people might say, oh yeah, I can do that. And it's like, the truth is, no, you can't. You can't, because you're going to go out and you're going to do it. And I mean, I had a conversation with one of the guys who was involved in the Big Short. I won't mention his name. He's quite a private individual. But anyways, and he told me the story about a buddy of his who was on the same trade. He had $30 million fund, and he went after this stuff. And he basically shut his fund in late 2006 because he ran out of capital.
Yeah.
And it's like, so you got to try and structure your trade so that you can last, so that you can get through to the end. And that's really important. So it's like, you can identify these things, but then it's like, how do you actually execute on it? And that's a whole different gig, and it takes a lot more work than most people anticipate. I mean, I've seen people come out now, like, so South Africa, I've talked about a bit, and people go, oh, well, I'll short EZA, which is the ETF for South Africa. And like, that's a stupid idea. There's about 20% of that is a company which doesn't even operate really in South Africa. So it's a South African company. It's domiciled there, but it's a tech company, internationally based, and its operations got nothing to do with the country. So like, it's a poor way to go about doing it. Anyways, so sometimes it's like you've got to go through that process of finding those sectors, and then it's a matter of how do you execute on it for, again, least risk. I look at the risk first and try and mitigate that as much as possible, and then and the reward will take care of itself. So
that makes sense.
And if you get a dozen of these types of situations and you structure a portfolio intelligently around it, it's hard to cock it up, because you're going to get stuff wrong. You're going to get your time frames a little bit wrong, and there might you could have a company. Let's say, take uranium. Well, you could say, oh, uranium's fantastic. You go after one company, and you could have a political environment that cocks it up. You could have the CEO run off with the CIO's wife. You could have any number of things that go wrong.
Yep.
So you've got to think intelligently about how you go about participating.
So tell listeners about Capitalist Exploits, about Resource Insider. What do you got going on there with your newsletters? And
yeah, so as you know, I've got a fund which we run, and then basically the research that we put together for that is we use that to provide retail, family offices, fund managers, and the likes with their own set of research that they can utilize to structure their own portfolios, and that we call Insider. That's a macro focused newsletter, and I put out a weekly on that, and then investment recommendations when and if they make sense. So there's none of this, got a monthly newsletter with a monthly pick. I don't know any fund manager that gets to the end of the month and goes, "Oh, I should buy something now." Shit, it's the 30th. Okay, so it's not like that.
Yep.
Do not expect a monthly pick, because that is asinine at best. Anyway, so that's Insider. And then what I built, because I wanted to be trying as best as I could to allocate my capital for best bang for buck within the resource space, is Resource Insider, together with Jamie, who's a mining engineer by profession, extremely knowledgeable, and worked all over the world, and really humble and honest, which is very important to me. And so that is for accredited investors, and that's basically pipes and pre-IPO deals and things of that nature, which we get into. And with that, all of that, I participate alongside members, pari passu. We won't put anything in front of people that we're not putting our own capital into. Again, this, the entire business basically is designed for me to leverage what I'm doing personally. And that doesn't mean that it's going to always work, but it does mean that I've got a vested interest in making it work. And
it's a good structure, right? Because you have people doing research, you do research yourself. Subscribers are the income from subscribers provides that research platform, and you're putting your own money behind your investment ideas. So I see how you structured it.
Yep, that's pretty much it. So what you see is what you get, really.
How do they get a hold of you?
My website, which is capitalistexploits.at. So capitalist, as you spell it, and then exploits, EXPLOITS.
And where do you hang your hat?
That's where I hang my digital hat.
That's your digital. Where do you your physical hat is hung where?
Mostly in this little beach town in New Zealand.
Nice.
Which in today's world, I've lived all over the place. This is the 7th country I've lived in. And, I don't need to be in, like I used to be in New York or Tokyo or London.
No, I don't need to be in New York either. I keep telling my wife that, but it seems my in-laws all live pretty close, so I'm kind of here.
You're probably stuck.
Yeah.
Yep. There's worse places you could be, Mike.
Yeah, I suppose. Anyway, Chris, it was great. I enjoyed, I thank you for your time. I enjoyed it. I love talking to you about investing.
Yeah, absolutely. I always enjoy chatting to you, and it's great to do it once again.
Yep.
So,
all right, we'll speak soon.
Thanks a lot, mate. Take care. Bye.
Well, I hope you enjoyed listening to Chris. He's a good thinker. I really enjoy the way he just thinks about the world of investing, the way he's looking to skew the odds in his favor. And that's what we're talking about on the asymmetrical side. It's not quite a heads I win, tails you lose proposition, but he's trying to make it as heavily skewed in his favor as he can. And I think it's a really interesting way to invest. And it keeps you out of the more popular stocks. That's for sure. You're not going to be popular at any Saturday night barbecues, but it can at times be extremely financially profitable. So anyway, I hope you enjoyed the podcast, and we'll talk to you next week. Thanks. Bye.
The information presented on Talking Stocks Over a Beer is the opinion of its hosts and guests You should not base your investment decisions solely on this broadcast. Remember, it's your money and your responsibility.